morning. Can you see the screen?
Yes, sir.
Yeah, okay. So yesterday we discussed the two important aspects of fundamental analysis, that is the economic analysis, industry analysis, and we have seen some issues related to company analysis also. So today what we do is we'll spend some time on analyzing the financial statements, right? So if you observe any company which is listed, will generally prepare the financial statements quarterly and submit the results or submit the reports. These financial reports consist of the financial statements consist of income statement, balance sheet, and cash flow statement, right? So these are the three financial statements any listed company has to report quarterly, right? And using these financial statements, we can analyze the company. So this is nothing but a ratio analysis, which helps an investor to determine the strengths and weakness of the company, right? So by analyzing the company using the ratios, what's being presented, we can understand or we can determine the strengths and weakness of the company, right? And the ratio analysis also helps the investors to assess whether the financial performance and financial strength are improving or deteriorating. That means, is say suppose if I take current ratio is increasing or decreasing, right? So you know whether the financial strength is improving or deteriorating. So improving financial strength is good, and financial strength should not be deteriorated. So properly analyzing the financial statements, we will be able to know whether the financial strength and performance improves or deteriorating. So ratios can be used for comparative analysis, either with other firms in the industry through a cross-sectional analysis, or with the past data through time series analysis. So what does it mean is, say suppose I would like to analyze, say FMC Dauber, right? So I can do this financial statement analysis on Dauber, right? In two ways. In a cross-sectional way, what I do is Dauber is compared with ITC, the ratios of ITC, the ratios of the Unilever, the ratios of P&G, right? Like this, right? So this is cross-sectional analysis where a company's performance in the sense of the financial statements is compared with the financial statements performance of the related companies with the same industry. Or what I can do is in a time series analysis, what I do is I can compare the performance of Dauber in 23-24 by checking the performance in 22, 23, 21, 22 like this. That's a time series analysis. Right. So the ratio analysis is used to determine the strengths and weaknesses of the company, right? And with the ratio analysis, we'll be able to know the financial strength and performance, is it improving or deteriorating. The ratio analysis can be used to compare the firm's performance with the competitors or its own performance in the past, right? So there are various ratios, right? And the first classification, right? Ratios being classified into liquidity ratios, activity ratios, profitability ratios, valuation ratios like this. So first classification of ratios is the liquidity ratios, right? So the liquidity ratios measures the company's ability to fulfill short-term obligations, right? And reflect its short-term financial strength or liquidity, right? So any firm generally have, right, long-term assets, short-term assets. So when I talk about liquidity ratios, we focus on short-term assets, right? Mostly receivables, cash, cash equivalents, marketable securities, like this, right? So are we having the enough amount of current assets to meet the current obligations. So the current assets are the assets which can be converted into cash, right? Which can be converted into cash within a year or operating cycle. Current liabilities are the liabilities which a firm is supposed to pay within an accounting year or the operating cycle, right? So current ratio, the widely used liquidity ratio, which is current ratio, which says that it's a ratio of current assets to current liabilities, right? So if I have the current ratio, right, as 2 is to 1, suppose if my current ratio is 2 is to 1, what does it indicate is for every 1 rupee of current liability what I'm supposed to pay, I have 2 rupees of current assets with me. That means I have excess amount of current assets than my current liabilities, which shows the company is liquid. The company is liquid. Higher the current ratio, better it is. But again, right? So when you're having higher current assets, right? What it could be? It could be cash, it could be receivables, it could be marketable securities, or it could be inventory, right? So again, having higher current ratio is good, but at what cost, right? So if you're keeping cash idle, you are losing interest. If you're keeping higher inventory, the higher inventory could be in the finished goods, right? Inventory consists of raw materials, work in progress, and the finished goods. So suppose if your current ratio is higher because of inventory and because of finished goods, that is not a healthy condition for the company, because the company should not keep the finished goods for longer time, especially the company falls in the style segment, say like maybe Reebok or Nike, or maybe shirts, right? The style fades quickly. So the company should not keep longer periods of the inventory. So that is, when you are having higher current ratio, you should dig deeper into the company reports to see why the current ratio is higher. Though it is good, but you should analyze or diagnose the company in knowing how and why the company was able to keep higher current assets than current liabilities. So keeping higher current ratio is good, but it should not be high, because the higher current ratio might be because of higher amount of idle cash or higher amount of inventory. Right? So the when we talk about the second ratio, quick ratio or asset test ratio, right? So what happens is the current assets, whatever the current assets we have discussed, inventory, cash, marketable securities, right? Receivables. Well, then if you remove or if you subtract inventory and prepaid expenses, right, you'll get quick ratio or asset test ratio, right? You'll get quick ratio or asset test ratio. So 1:1 is ideal because you're not taking inventory and prepaid expenses, right? So 1:1 would be ideal. Higher current ratio would enable a company to meet its short-term obligations even if the value of the current assets decline, right? So quick ratio is between quick assets and current liabilities. So the denominator is same. In the earlier ratio, the denominator is current liabilities. Here also it is current liabilities, but the numerator changes, right? The quick ratio or acid test ratio is more rigorous measure of liquidity, right? When it comes to the leverage ratios, right? These are capital structure ratios. Again, when we talk about capital structure ratios, capital structure, what does it mean is the proportion of debt and equity. The proportion of debt and equity tells the capital structure, right? So suppose if you see debt equity ratio, total debt ratio, proprietary ratio, right? So everything which is related to debt and equity, they measure the company's ability to meet long-term obligations, right? So in the earlier case, the liquidity ratios were used to meet the company's short-term obligations, and the liquid leverage ratios are used to meet company's long-term obligations, right? They throw light on the long-term solvency of the company, right? Whether the company is able to cope up with the challenges in the long term. Right? So the commonly used the commonly used leverage ratios or debt equity ratio, right? So these are easy to remember actually, right? So debt to equity ratio. So numerator is debt, the denominator is equity, right? So when it comes to total debt ratio or debt to total assets ratio, right? See, it's the total amount of debt to total amount of assets, right? If you see the balance sheet, if you observe the balance sheet, right, just let me write here. Assets is equals to liabilities plus shareholders equity. Right? This is the accounting equation. Right? Assets is equals to liabilities plus shareholders equity. Right? So in a debt equity ratio, you're taking only long-term debt to shareholders equity. Right? So again, right? Assets could be long-lived and short-lived. Long-lived assets, short-lived assets. Liabilities could also be long-lived and short-lived, right? So what does it mean by long-lived assets is generally the non-current assets, right? Short-lived assets are the current assets. Long-lived liabilities are non-current liabilities and short-lived liabilities are current liability. So current, non-current, right? So assets could be current as well as non-current. The liabilities could also be current and non-current. So when I'm talking about debt to equity ratio, I'm taking only long-term debt to shareholders equity, right? Which both are long-term. Total debt ratio, right? We'll take the total debt here. We take the total debt. When I say total debt, it is long-term as well as short-term divided by total assets. Right? Total assets is A, current assets plus non-current assets. Proprietary ratio is the shareholders' equity divided by total assets. What does it mean is proprietors, the owners, right? The owners of the company are the shareholders. So that's the reason why we take numerator as the shareholders' equity. When we talk about interest coverage ratio, right? So earnings before interest and taxes divided by interest. What does it mean is how much portion of the interest you would be able to pay, right? See, what this interest coverage ratio measures? It measures the ability of the company to meet its interest payments arising from its debt. Right? So when you raise debt, and when you raise equity, there is no obligation for you. You know, if you are profitable, you pay the interest. If you are not profitable, you don't pay the dividends. Right? But when you raise capital in the form of debt, you will have an obligation. When you raise capital in the form of debt, you will have an obligation to pay interest to the creditors in the agreed times, right? Maybe yearly or semi-annually like this, right? So to know your ability, to know the firm's ability to pay or cover the interest payment on debt, we calculate interest coverage ratio. So the first three ratios indicate the relative contribution of owners, right? Relative contribution of owners and creditors. If you see, when I say the relative contribution of owners and creditors, what does it mean is owners are the equity, those who contribute equity, the creditors are who contribute debt, right? So the first three ratios indicate the relative contributions of the owners and creditors, the people who supply the equity and the people who supply debt. Right? So coming to the third type of third variant of ratio, profitability. Right? The profitability of the company is measured using profitability ratios. right? These ratios are calculated by relating the profits either to sales or to investment or to the equity shares, right? What does it mean? You might be calculating profit versus sales. That means how much profit you made, how much profit you're making, right, on sales, how much profit you're making on investment, right? Because all the investment is sales is different from investment, right? Or it's related to equity shares, right? So if you see these ratios, profitability related to sales, right? When we're calculating profitability related to sales, just a minute. So when we are talking about profitability related to sales, gross profit ratio is gross profit by sales, operating profit, right? So EBAT is also called as, so EBAT is earnings before interest and tax, which is also called as operating income, right? So in all these measures, when we are calculating, right, when we are calculating the profitability versus sales, the denominator is sales. We are calculating how much gross profit we are able to generate against 1 rupee of sales, right? So how did we calculate gross profit? It's sales minus cost of goods sold, right? And if it is operating profit ratio, right, it's a gross profit ratio is gross profit by sales. So operating profit ratio is EBIT by sales. EBIT is operating income, right? So when you deduct, right, the depreciation and amortization, the other expenses from the gross profit, right, you'll get operating profit, right? That is EBIT. Net profit, right? So after tax, first you have to pay interest, then you have to pay tax, then preference dividend, right? Then you'll get the net profit ratio, earnings after tax. That is net income available to net income available to equity shareholders. Right? Net income available to equity shareholders divided by sales. Administrative expense ratio, right? So this is one of the measures, right, to be used to how much is the administrative expenses the company is incurring to one for every 1 rupee of sales, right? Selling expenses ratio, right, where the, the amount of expenses what the company is incurring for every rupee of sales, right? Operating expenses ratio, right? So administrative expenses plus selling expenses, right? So sorry, administrative expenses and selling expenses, right? So if you see the balance sheet of any company, right, you generally see the expenses mentioned. Right? You are supposed to take all the expenses which are related to administrative and selling expenses. Sum these expenses divided by sales, you'll get operating expense ratio. The operating ratio is cost of goods sold plus the operating expenses, right? So if you see this, administrative expenses and selling expenses are operating expenses. To this operating expenses, you are supposed to add cost of goods sold, right? Cost of goods sold, right? Then you'll get operating expenses, right? The the operating expenses plus administrative expenses, sorry, the cost of goods sold plus administrative expenses and selling expenses gives you operating ratio. So when it comes to profitability related to investment, right? So earlier we have seen the profitability ratios related to sales, right? Here we are talking about profitability related to investment. Okay? So return on assets, earnings after tax divided by total assets, right? EAT, how do we get EAT? Net, that's the net income available to equity shareholders. Return on capital employed, right? See, EBIT divided by total capital employed. Total capital employed is again equity and debt, right? So return on equity, you are calculating only is how much return you are able to get on equity, right? Earnings after tax is the earnings available to equity shareholders for every 1 rupee they contribute. Then profitability related to equity shares, right? Profitability related to equity shares, earnings per share. So this is very, very important measure. Any issue? Anil, please. Anil, please put it on mute. So profitability related to equity shares. So earnings per share is net profitable available to equity shareholders divided by number of equity shares. Right? Earnings yield. Right? So once you know earnings per share, right, you can calculate earnings yield, which is EPS divided by market price per share. Right? Dividend yield is DPS by market price share. Dividend payout ratio is DPS by EPS. So if you say suppose, let me just, if earnings per share is say 10, dividend per share is say 4, right? Market price of the share is 100, right? So what happens is earnings yield is equals to earnings per share divided by market price of the share. 10 divided by 100, which is equals to zero point 0.1, right? Or 10 percentage. And if you would like to calculate dividend yield, it is dividend by market price of the share. 4 divided by 100, which is equals to 0.044 percentage. Right? If you would like to calculate dividend payout ratio, it is DPS by EPS, which is 4 divided by 10, it is equal to zero point 0.4, right? That's 40%. So when we say dividend payout ratio is zero point 0.4, what does it mean is for every 1 rupee earnings per share the company gets, right? The 40 paisa is paid in the form of dividends, right? So suppose if the company gets 100 rupees earnings, 40 rupees of these earnings is paid in the form of dividends to equity shareholders, right? That's a dividend payout ratio. And the 60 rupees will be with the company in the form of retained earnings. That gives us the dividend payout ratio. If dividend payout ratio is 40 percentage, retention ratio will be 60 percentage. If dividend payout ratio is say 80 percentage, the retention ratio is 20 percentage. So DPR plus retention ratio should be 1. Price earnings ratio, which is market price per share divided by EPS. Return on investment, right? So you can calculate earnings after tax, that's the return what you get divided by total assets. So current assets turnover, right? So turnover ratios means these turnover ratios measure the efficiency in asset management. Right? So they express the relationship between sales and the different type of assets, showing the speed with which these assets generate sales. Right? So what does it mean is, if we have current assets, right? If we have current assets, for every, say suppose if current assets turnover ratio is 10, current assets 10, turnover is 10, right? So what does it mean is, for every 1 rupee of current asset what I have, I am generating a sale of 10 rupees, right? So this, they express the relationship between sales and the different types of assets, showing the speed with which these assets generate sales, right? So sales by current assets turnover, fixed assets turnover, sales by fixed assets, total assets turnover, sales by total assets, which the total assets here, the total assets here takes fixed assets plus current assets. Just let me tell you this inventory debtors in a different way, right? Company generally have the operating cycle. The operating cycle is the length of time taken to convert purchases, right? You purchase the raw materials from the vendors, and you're supposed to use these raw materials, manufacture the finished goods, sell, right? The sale will create receivables. These receivables has to be converted into cash. So the net operating cycle is the length of time taken to convert purchases to cash. Right? This is the, we call it as net operating cycle is called as cash conversion cycle, which is inventory conversion period plus receivables conversion period minus debtors conversion period. Right? The cash conversion cycle is the net operating cycle, which is the length of time taken to convert the purchases to cash. The inventory conversion period, receivables conversion period, and the debtors conversion period. You're supposed to see that the inventory conversion period is low, receivables conversion period is low, and debtors conversion period should be generally high, so that your cash conversion cycle will be low. Suppose if your company has cash conversion cycle of 20 days and your competitor has the cash conversion cycle of 30 days, right? That means you're performing better than the competitor, right? You're performing better than the competitor, right? So once you calculate inventory turnover, inventory conversion period is equals to, inventory conversion period is equals to 365 divided by inventory turnover. Inventory turnover. Say suppose inventory turnover is 10. 365 by 10 gives you 36.5, which indicates, right? It is taking 36 days to convert purchases to finished goods, right? And you're selling 36.5 days. And 10, which is dead inventory turnover ratio, 10 indicates, right? Your inventory is converting to finished goods 10 times in a year. So activity ratios or turnover ratios are used again to measure the liquidity. Right? So you're also supposed to calculate the leverage, right? Operating leverage, financial leverage, and total leverage. Right? So this is more about the fundamental analysis. Now we'll just move to the other concept called technical analysis. Right? So in fundamental analysis, what we generally do is we analyze the company, right? And we arrive at a stock price. We compare the stock price with the market price of the stock, and then we decide whether the stock price is undervalued or overvalued. Right? This we arrive by analyzing the economy, by analyzing the industry, and by analyzing the company. In technical analysis, right, what we do is the entire thing is dependent on price and volume. Price and volume. Right? So technical analyst, right? So suppose if you are using technical analysis, you are a technical analyst, and the technical analyst believes that the share prices are determined by the demand and supply forces operating in the market. Of course, the price of any commodity in the world, let it be equity, let it be bonds, let it be gold, or let it be crude oil, right? Any commodity or any asset price is determined by the two market forces, demand and supply, and the technical analyst believes that the price of the stock is or the share price is determined by the demand and supply, right? And these demand and supply in turn influenced by various factors, right? Psychological or emotional factors, right? Many of these factors cannot be quantified, right? And the combined impact of all these factors is reflected in the share price movement. So as the many of the factors cannot be quantified, right? You cannot take all these into concern. So technical analysis therefore concentrates on the movement of the share price. So as I mentioned, technical analysis is more about the price and volume data of the asset. Let it be share, debt, or whatever. Right? You're not focusing on any other factor like in fundamental analysis you would like to know the industry, economy, everything. But in technical analysis, everything will be done based only on the two important factors, price and volume, right? As the technical analyst believes that there are certain factors which make the price of the stock to move cannot be quantified, right? The technical analyst claims that by examining the past share price movement, future share prices can be accurately predicted, right? So by using the past data, you will be predicting the future prices, right? So to get right. So technical analysis, to understand technical analysis in a better way, it is right better for us to understand the Dow theory, right? And the reason why we call it as Dow theory is it's being proposed by right Charles Dow, right? Formulated a hypothesis that the stock market does not move on a random but is influenced by three distinct cyclical trends that guide its direction. Right? So if you see the basic hypothesis, what was formulated by Charles Dow, right, is the stock market does not move on a random, right? The stock markets do not move on random, but they're influenced. The market is influenced by three distinct cyclical trends that guide direction, and these three distinct cyclical trends are primary movements, secondary movements, and minor movements, or tertiary movements. The market doesn't move on random. If a market is moving, it's because of the three factors. It's because of the three factors. They are primary, secondary, and tertiary. Right? Right. Suppose if you see this, the graph, right, and this line is the primary trend. These are secondary movements, and the market will also get influenced by the tertiary movements. So we'll see what are these primary, secondary, and minor movements. If you see, the primary movement is a long range cycle that carries the entire market up or down, right? So when we say the primary movement, it could be either up or it could be down. This is a long term trend in the market, and if you see, though there are fluctuations, right, ups and downs on for a particular time period, right, it's a up movement. The secondary reactions act as a restraining force on the primary market. So the secondary reactions we have seen, there are three factors, right? The primary is either up or down. The secondary reactions act as a restraining force on the primary movement. In the sense that if the market is going up, there might be a point where the secondary reactions start acting against to it, and it causes a fall, right? Once the market is falling, then there are secondary factors which make the market to move up, then down, then up, like this, right? These are known as corrections. So we hear this word again and infrequently in the markets where the market has corrected. What does it mean is when the market is moving up, it gets some secondary reactions and the market falls. We call this fall as a correction. When the market is moving upwards continuously, the upward movement will be interrupted by downward movements of the short durations, right? And these are secondary reactions. The third movement in the market is the minor movement, which a day-to-day fluctuations in the market. So overall, it might be upward or downward, but if you take day wise, it could be there could be a lot of fluctuations which are minor and insignificant. The minor movements are not significant and have no analytical value as they are of very short duration. So the tertiary movements are the minor movements are of very short duration, and there is no we do not take them significant. Hello.